Last week was undoubtedly a wild week. We saw big moves in the stock market, down, up, down. But I think there's something subtle brewing below the surface that you might have missed. I don't know if you know this, but the US dollar is acting like a third world currency. If you're not paying attention, rates went up and the dollar went down. That is not supposed to happen when you are the creme de la creme of currencies. When rates go up, the dollar should strengthen. But last week, that broke. This is what happens in third world countries. Rates go up and your currency gets weaker because they are afraid of what's coming. They are moving their investment dollars out of your asset, the US dollars, and into gold, into crypto, into other currencies. The US economy is facing a potentially significant change where the full faith of the US government, the US system is breaking down. I'm not saying we are a third world currency. I'm saying it's acting like a third world currency. And this could be a problem. So, Mr. Bird, I know you were busy with your daily updates on the market. It was wild rides. But I want to start this conversation with the US dollar and the fact that rates went up and the dollar weakened. This is not normal, nor is it good.
Not only is that not normal, what also is not normal is the 20-year bonds. When the market goes down, they should go up. And they're not acting normal either. So
something is afoot.
And I've mentioned this a few times over the last few months. And mostly it was in context of government spending, where I said the politicians are not going to stop spending, but the bond market will stop them from spending. And at some point, the bond market is the one that's going to step in and start sending the signals. Now, I thought that might take another 4 or 5 years, but it could actually be happening now.
You know, it's funny. There was a tweet or whatnot from someone the other day saying, "When I am reborn, I want to come back as the bond market because
Yeah,
the
that
bond
was
market is the only
somebody.
thing that pushes people around."
Yeah, I can't remember who said that, but it was.
I think it was Carville, Jim Carville or
Yeah,
something. I
that's
forget
right.
his.
Yeah, James
Yeah,
Carville. That's right. Only come back.
James Carville
James
as the
Carville.
bond.
Yeah,
Yeah, and
yeah,
again, the bond market did it again. The bond market proved its force on Wednesday, right? When the 10-year note broke from 4 to 4.5 Tuesday evening, the 30-year note hit 5%. Look at what happened on Wednesday morning. President Trump introduced a 90-day pause on most tariffs. The bond market has power. And again, I think it's sending a concerning behavior. It's not normal, Dan. What the heck is going on?
So if let's put this into context, and I'm going to show you some things from my newsletter that I just literally just finished and sent out today
Nice.
because I've had a very busy weekend. I did a session here in my community for 2 hours yesterday morning, and then I did one for my subscribers for 2 hours on Zoom,
Nice.
and then I had to go out to dinner with my wife.
Oh, come on. Yeah, well, you are
But
retired. You are supposed to enjoy life, so that's good.
I'm enjoying it.
Nice.
But here's I've been reading a few things, and I posted a few links to articles, some really interesting articles related to bonds, related to this topic in particular, related to China and tariffs and the whole thing. And I'll throw out a couple of things that I took away from some of those articles. One is 25% of our debt comes due this year.
Yeah, no, $9 trillion. Yeah, Janet Yellen made a tactical error when she
Yes.
went so short. The
Yeah.
debt needs to be termed out. This is a problem. This
This
is
is
why
a
Bessent.
this is a huge problem, and I believe that it's underlying a lot of things that are going on. So yeah, Janet Yellen made a huge mistake. She refinanced the debt on a short-term basis because rates were zero practically. So why not? But the problem,
Here's a hint for legislatures. Anytime this happens again, term out the debt to 100 years if you can.
yeah, no
Stop
kidding,
going short.
no kidding. So we have to refinance the debt. So if we can't get the rates down, the bond rates down, the 10 years not necessarily the number one rate, but it's the one that everyone looks at. So
Yeah, it's one that we can watch daily. And again, it's not
Right.
behaving great. It again went up on Friday.
Right.
So
So
yeah,
if they can't, and I think that's what Bessett's trying to do is to
he
get that
nope
10-year down.
he yeah he's been very explicit
And
that
it
he's trying
could
to.
even be part of what's happening with tariffs under the covers is maybe even push the economy into a recession,
I
even
have proposed that. I have proposed that. One of the
even if it's a brief one, push it into a
yeah
recession just long enough to get the rates down so that we can refinance our debt. So
yeah yep.
that is the thing that needs to be front and center in these conversations. Everyone has to keep that in mind that a lot of these things that are going on might well probably are related to refinancing 25% of our debt. So
Yeah, very quickly this year. Yes,
yes,
not just.
this year that has to happen. And I don't know exactly what the deadline. I'm not sure what the date is when we say this year, but
I've read articles saying that it all comes due because again, it's they all have different dates, but the
yeah,
majority of it comes due in the next 6 to 9 months.
right. So that's basically over the summertime
Yep,
and going into the fall, which is exactly the time where I've been saying we're probably going to get another sell off. We're going to
yes, you
have
have.
a brief rally, and I'll show you the chart about that. But all of this kind of lines up with that, even with
Mm.
the nice rally that we had last week. Now, two times so far, and I've been trying to explain this to people in my meeting in my community yesterday. I started off by saying, I'm going to tell everyone some things that you're not going to want to hear, but you need to hear it. You need to understand what's going on. And there was one guy in particular that kept coming up with justifications of why the market, this is just temporary and that it's going to go higher. And I said to him, are you underwater with a lot of your investments? And he goes, yeah, I am, but I think it's going to come back. So, and it happened twice. It happened in my Zoom call too. So I think there are a lot of people out there that are trying to justify the fact that the market had been doing so great and we've had a temporary setback and it's going to go back to new highs again, hoping that they can break even.
Yeah. So I've actually termed this, or in my opinion, again, I think a lot of investors of today's ilk are I don't know if spoiled or used to is the right phrasing, but they're used to things going up 20% a year. See the last
Right.
2 years. The
Yeah.
other thing they're used to is violent V-shaped recoveries,
Yes.
violent by the dip. They have
Yeah.
been conditioned to
Which is
this.
what last week felt like.
No, sure, absolutely. They don't realize that you could have a lost decade, right?
Right.
You and I have lived through a lost decade of investments. That can
That's
happen. They're not all V-shaped.
that is a secular bear market. They
Yes,
happen regularly.
correct.
2000 to 2013,
Yeah,
technically.
it can happen.
Um, Now, I said I've been saying it's going to happen again. I didn't think it would be until 2029 or 2033, somewhere in that
Mhm.
neighborhood. But that doesn't mean it has to be that time. It could be
Oh,
this year.
could be.
This could be the
It could be.
start of
It
it.
could be right now. It could have.
Right. This could be
Yeah.
the beginning. Now, I do think that we are going to have one last gasp rally before it
Okay.
happens.
Mm.
It's going to suck a lot of people in,
Oh yeah.
uh, like I think last week did, and or if not sucking people in, like these two examples I just gave you, giving people the justification that the market's going to come back at least enough so that they can break even and they won't have to take a loss.
Yeah.
But sometimes it's better to take a small loss than to take a big loss. So
I totally agree.
I cannot stress that enough. That the things that I'm seeing that are lining up are indicating that we are getting ready for a much bigger downtrend
Mm.
than we've been used to over the last 15
Yeah.
years.
Well, let's get into it. Let's take a peek at your newsletter again. The topic of the day for me is the U.S. dollar is acting like a third world currency, but there's probably a lot more to it. Obviously, you're going to show us the stock market and others, but this is a trend that's not normal and one that bears watching. I certainly will be doing that.
Yep. So this is my website for anybody interested, breakpointtrading.net. On the website is my YouTube channel right there in the upper right corner. Very easy to get to it. I try to do one every day after the close.
Mm.
They post at 7 p.m. Eastern time every day. So far I've been able to do it every day. Can't guarantee
Nice.
it, but
Yeah, you give it
Um,
your best effort. That's great.
yeah, and I don't know if you've read any of the comments that have been out there. I've had people say, "I've been watching you for a while, and when you started warning us in December, January, and into
Yes.
February, I moved to cash. You have saved me $52,000 so
I
far."
it's funny. I read all of my comments and I have to say every week we do this, there's somewhere between 6 and 12 comments that sing your praises because you have saved. There's a couple of people that said six figures,
Right.
so that should make you feel good.
Yeah. Well, that's why we do this.
That's right.
For education to teach people
Yeah.
and
Hopefully they take action. It's on them.
hopefully they take action. Right. Um, but some people don't. Some people, it's human nature.
Yeah, of
Human
course.
nature is, they expect things to be the same as they were before,
Hmm.
and they don't recognize or they justify away when things
Yeah.
start to look different.
Yeah.
So that's just human nature.
Sure.
But let me show you a chart that I was putting together this morning, actually, based on what you just talked about, which is 20-year bonds, the 10-year yield, and the U.S. dollar.
Hmm.
All right,
Look
and
at
the
that.
S&P. So first of all, when the S&P goes down like this, 20-year bonds should go up.
Yeah, usually, folks, there's a flight to safety, and
Right.
those go up. That did
Yeah.
not happen.
And
This
that's
is
not happening.
breaking trend, not normal. Something's afoot.
That is not normal. The 10-year yield, you can see as bonds come down, the yield goes up.
It too should go
And-
down when the stock market because of flight to safety. This again is not normal.
right. It's not normal. And then the US dollar, now these are performance charts. So what that means is they for this time period, which I think is 5 years. Yeah, 5 years. For this time period, they all start at zero.
Correct. Yep.
So they all start at the same place, and then you can just see the trends based on what's happened over a 5 year period.
Yeah. And again, folks, when the 10-year goes up, the dollar should strengthen. And as you can see on this
Right.
chart, it is not behaving normal. This is a
Right.
problem.
Yeah, you can see over through here, um, the 10-year went up, and the dollar went up.
Yep.
10-year came down a little bit, dollar came down, 10-year went back up, dollar came back up, but not as high as before. The 10-year actually was higher than the previous one. The dollar was not. So it was already showing you that it was weakening.
Yep.
But right now, the dollar is basically falling off a cliff while the 10-year is going higher.
Yeah. This
So,
this is this chart right here. Scott Bessent is looking at.
yes,
He has a version of this chart, and he is asking himself, what the hell is going on?
yes,
You know what would
absolutely.
be great to add to this? You know what I would throw on gold here because gold is ripping. So what I think's happening, actually, Joseph Wang, shout out Joseph Wang, always give credit where credit is due. He is saying that Asian investors are liquidating bonds and buying gold. That's what he
Hmm.
is saying.
Well, that's a good idea. Let's do that right now.
Look how good you are.
And let's make it a gold color. How about that?
You're
There's
awesome.
gold.
Look at that. The 10-year up, the dollar down, and gold is ripping. Folks, something is afoot.
Yep, definitely. Something is afoot, and something that could be major is afoot.
Yeah, that's what I'm trying to say. This could be major.
I actually like that idea. I'm going to add this in here. Let me put, just give me a second. I want to add gold in here like that. And this now is my new chart.
Shout out Joseph Wang for giving us this idea. Give credit where credit is due.
All right, so there's gold, US dollar, gold going opposite directions.
Not good. Not
All
good.
right. So let's take a look real quick at CPI because CPI came in
Yeah,
much
talk
higher.
talk about talk about a great number meaning absolutely nothing. Both CPI and PPI this week were amazing, much better than expected. In fact, I think it was CPI actually had deflation on month basis, and
There,
it
there,
means
there it is
absolutely
right there.
nothing.
I circled it in red. It's right there.
Yeah, deflation. It's funny. Talk about meaning absolutely nothing. If we would have got this number last month, rates would have been much, much lower. But of course, it came out last week. It means absolutely nothing. Because did you see consumer sentiment on Friday?
Yes.
It is crashing, and
Yes.
inflation expectations are at 1981 levels. That's not good.
So, interestingly, Tom Bowley, a guy that I follow, he sent out a note to his subscribers on Friday, and he mentioned the consumer confidence number, the lowest in history,
Yes. Yeah.
lowest ever.
Ever. Ever.
So what did he interpret that as? He said, "I am going all in."
Oh, it's a buying signal. It's the bottom. Okay. All right.
When consumer confidence gets that low, that is typically a buying signal. That's when the market's bottom.
Well, I love his I love being committed. I don't know that I'm going to follow that advice, but I like being committed.
I am not following that advice,
No, I am not following that
and
advice.
I am trying to be as clear as possible with everybody. And I said it once already, but I'll say it again. Sometimes it's better to take a little loss than it is to take a big loss.
Yeah.
Um, but anyway, this is CPI, so I've been saying this over and over again. This is the one that dropped off the last week's report,
Yep.
and I said that it's going to go down. It went down even lower than forecast to
Mhm.
2.4.
Yeah. More importantly, core broke 3% for the first time since 2021.
Yeah, core is at 2.8.
Yeah.
But look at next month. Next month's got a big one too.
Yep. And then things get
And
interesting.
then we've got the
Tariffs.
so you said that other chart, Scott Bessent was looking at that. Well, this is the one that Powell's looking at.
Exactly. Jerome Powell is looking at this going, I'm screwed. Tariffs will be in full effect, and the base effect is not his friend.
Right. So what will he do? What's he going to do? I mean, this is one of the things that both of those guys I mentioned before were using as justification that the market's going to go higher because the Fed is probably going to cut in May.
No
And
chance
while
they
they
cut it back.
while they
No
may
chance.
they might cut in May, they probably won't because number one, the jobs number came in just fine.
Yeah, it was
We're
great.
probably going to get a little worse jobs number at the beginning of May, just before that next meeting. It'll be a little worse than this one, but
Yeah,
it probably won't be
probably
above the
still positive. Probably still positive.
probably won't be above the 4.4 that he has targeted for this year.
No chance they
So
cut it back. No chance.
so he's not and he's this is what he's seeing right here.
Of
He
course.
he knows this too.
He
So he doesn't cut
so
in May. We get another CPI after his meeting,
yep.
right? So the
Mhm.
May CPI comes in after the Fed meeting,
Correct.
and it could be close to 2%.
Yeah, it could be 2.3, 2.2. I mean, look at commodities, oil's down, all this other stuff.
No, it could be
Good.
close to 2%. It's 2.4
Correct.
right now. Look what it's done in 2 months.
Yeah. No,
Gone
you're
from
right.
3 to 2.4 in 2 months.
It could.
So it went from 2.8 to 2.4. It went 0.4% in 1 month. It could do it
Could.
again.
It could. It could.
So it could be 2.1, 2.0, 2.1, something like that.
Yeah, it could.
So there is no reason for him to cut based on this, and he sees this coming. So if he were to cut, let's say he cuts in May, and then in June we see CPI spiking higher. What's he going to
Exactly.
do then? Going to turn
That
around and hike?
that's exactly why he won't cut. Because I think I've read 3 or 4 different Fed presidents in the last 72 hours say basically they don't want to move one direction only to
Mm-hmm.
have to go the other direction.
Right.
They would
That's
rather
right.
sit tight. That's exactly what I see coming. That's why they won't cut in May, why they won't cut in June, because they don't want to cut and then be forced to raise. That would
Right.
be
Right.
detrimental.
Yes. But will they raise in June?
That's a good
I mean,
question.
so that conversation is they don't want to cut and then have to raise.
Correct.
But let's say they don't cut and they don't cut, but then do they raise?
No, I think at this point the Fed is sitting on their hands. I think the Fed is holding their breath trying to get through all of this. I don't think they want to go either direction. They don't want to hurt the economy any worse, which raising rates would. They see the 10-year. Again, folks, don't forget, just because the Fed cuts doesn't mean the 10-year goes down. The Fed's cut 100 points and the 10 years up. So
The 10
my
year went up, right, which is
yeah,
not normal.
not normal. So again, my impression is the Fed is they're going to sit on their hands for as long as possible. In fact, the only way I see the Fed making any move and the move is lower is if the financial system breaks.
Yeah, we'll get to that in a minute.
That's the only way. Other than that, the Fed's on hold potentially all year.
Yeah, we'll get to that in a minute.
Okay.
So something that I added, this has come from a subscriber, and I love when subscribers, come up with great ideas and ask me
Oh
to
yeah.
add them to the website. So they said, I've been thinking about the international trade. It seems like maybe money is moving to other markets
No
out of
question.
the U.S. I said, that's a really interesting question. So I put together these charts here. First, we'll look at a performance chart. This is also all starting at zero. So
Yep.
this is for 7 months. All right. So I have Germany, the Eurozone, Canada, emerging markets, Japan, and VTI is the total U.S. market.
All right. So where's the US on this? It's the pink one,
Well,
right?
first look at the one on the left. So the vertical line here is February 19th, which is essentially when the market started to crash.
Okay.
All
Got
right.
it.
So on the left-hand side, US is at the
You know
top.
what? Sorry to interrupt. I actually don't think that's the line I would put. I would put the line at Liberation Day
Uh,
because that's where you see the dramatic move, right?
what was that date? Do you know?
It's like the 6th of April. Or wait, no, wait. We can look it up. Hold on.
No,
That
that
wasn't.
that that was the crash. No, I don't want to put it there. I don't want to put it there. I want to put it where the US market started
Okay,
to crash,
that's fine.
started to come down because it's much more
It was
clear what happened
just so we're clear, it was April 2nd, just so we're clear.
April 2nd. So that's way over here. It's already
That's
crashing.
exactly, yeah,
Yeah.
that's why I'm
But
looking. Look at that dramatic move,
it's
though.
better here. So let's just look
Okay.
at this is February 19th. This is when the
Right.
market started to roll over.
Hmm.
Just before it, we made all new highs, all-time highs,
Hmm.
and just after it, we started to come down. And we have not stopped. So on the left side of this line, you see the US on top, and you see the Eurozone on the bottom.
Right.
All right, Germany right in the middle. On the
Okay.
right side of this US market crashing, you see the US on the bottom, and you see Germany on the top.
Mm.
Completely flipped over, except Japan didn't really move. But this is really clear. I mean, the next one is going to show you when this actually started to happen. It's one of the reasons why I put the line here. So this is a performance chart, which means they all start at zero 7 months ago.
Yeah. Okay.
So this is what they all did for the last 7 months. If you had a race and you had them all starting in the starting blocks at the same time, this is right now Germany's winning the race. All right, the same markets now on a relative graph. So relative to the U.S.,
Mm.
how did they do? So in this particular case, it's if they are trending up, so it's basically the first parameter is the other market, the second parameter is the U.S. market.
So just so I'm
So
clear, the pink is the US in this example?
pink is just a 50-day moving average. That's all
Oh,
it
that's the
is.
moving average. Got it. Okay. Okay.
Yeah.
Oh, I got it. I got it.
It's the actual line. The moving average tells you, whether it's trending up or down, essentially.
Okay.
When it
Right.
crosses that moving average, then it's begun an uptrend.
Got it.
But the line itself, essentially, it's a relative view. So you can see it over here. It's emerging markets divided by the US market.
Understood.
And what that means is the simple explanation is if the line is trending up, then the first parameter is outperforming the second parameter.
Got it.
All right. And I put them in the right order here. So emerging markets is the first parameter versus the US is the second parameter. So if it's trending up, emerging markets is outperforming the US. Okay.
Mhm.
And you can see each of these. And this is the actual US market up here at the top. So you can see pretty much where they started to move. And this vertical line is exactly the same date, February 19th.
Yeah.
You can see where they actually started to move. Eurozone way back here in
Yeah.
January started to outperform the US. Germany in January started to outperform. Japan took a little longer. Canada was the last one to get
Mm.
started, emerging markets. But right now, They are clearly all trending higher.
Yeah,
So,
I'm reading more and more articles about people, the US has got a little stigma to it, and they don't they're moving their dollars out, moving them elsewhere. This
right.
clearly paints that picture.
Yep. Yep, that's right. I mean, if unfortunately I didn't have this chart 6 months ago,
Right.
but if we had had it 6 months ago, we could have seen the other markets all moving down. We would have said, okay, yeah, that makes sense. That's what we expect. U.S. market is stronger. It's going up. These are going down. But we also would have seen when they started to cross.
Yeah, that would have been
We
interesting. That
could have got
makes sense.
into these back in January. Now it might not be too late. This whole trend could continue. So the other one that I put on here, I'm kind of playing with this one a little bit,
Hmm.
is
I hadn't
the
thought of this.
US 10-year versus the German 10-year.
Oh, interesting. I have no idea what this is going to look like.
And in this case, this up here, it is not a relative chart. In other words, it's not one divided by the other. It's
Hmm.
one minus the other.
Oh, the delta, the spread.
Yeah, that's right, the spread. So that's exactly what it is, the spread. And the actual um, chart is this light gray one. These are moving averages, the ones that are colored. But the light one back here is the actual spread.
So is that saying, so it's saying that the spread is widening. So that
Yes.
means the US dollar, given the math, is going higher and the German 10 years not really moving.
It's the US 10-year
Right, minus the German.
minus the German 10-year. So if you take one number and subtract the other and
Yeah,
they come out to zero, they're both equal, right?
yeah. So just by looking at the chart, the 10-year US bond is going up where the German is
Yes.
basically flat, which means the
Correct.
spread is getting bigger.
That's right. And that's because Germany and other countries have dropped their rates as we have kept the rates steady.
That is wild. They're dropping rates, we're keeping them steady, and we still look worse. That's not normal.
That is not normal. And you can see the dollar and the 20-year bond down here too.
Yeah,
Usually,
the
usually,
currency that I read this morning that's showing this the clearest, and I actually don't know what their symbol is. It's the Swiss franc, I think it's called.
right.
That
Yeah, I'd have to look it up.
yeah, we could have that next week. But that's the currency that people are saying is showing the most flight to quality or I don't know what you want to call it, out
Yeah,
of the
this
dollar
this particular chart is just looking at the 10-year yield.
yields. Yields, yeah.
But I could do one for currencies too. But based on the 10-year yield, so think about this for a second. The other countries, Germany in particular, Germany is the country that most closely resembles the US
Sure. It's the
economy.
biggest in Europe. Yep.
That's right. And so if they've dropped rates as we kept ours steady, um, then what does the Fed do then? Right? If it's more expensive to take out a loan to build a factory in the US and it's
Yep.
cheaper to do that in Germany,
Yep.
where are businesses going to move? To Germany, right?
Yeah,
So what
The
does the
Fed's
Fed
not
do?
looking to
So what does the Fed do in this case? I mean, the Fed can't really control the 10-year yield.
nope.
This again goes back to the same topic. This is not acting normal.
No, this is again, folks, we are in such unusual times. There are so many trends that are decades, almost rules that are breaking down right now.
Right.
This is just another one of those things that is highlighting how unusual the time we're in.
Very unusual. So before I go to look at my newsletter, because there's a couple of really important things in there. I
Yep.
created this bottom finder chart that I've showed before.
Mhm.
This is the one that I use to determine whether we're at a bottom or at least at a point where we're going to rally.
Mhm.
And there's a few components to it. The blue, red, and gray one down here are the percentage of this is I use the NASDAQ 100 because there's 100 stocks, so it's very easy
Sure.
to
Yeah.
convert. So the percentage above their 20-day moving average, so it's 27%, but that means 27 stocks.
Right.
Percentage above the 50 is 18 stocks. Percentage above the 200 is 33 stocks.
Mhm.
When we hit the bottom right here,
Yep.
Do you know how many stocks were above their 20-day moving average?
Zero.
Zero. None of them. Not
Yeah,
even one. Not even
that's
one.
that's
And
wild.
and the percentage above the number above the 50-day was only four.
Oh gosh.
There were only four stocks. That is bottoming territory.
Right.
We clearly were going to get a rally from here.
Mm. Yeah.
If you follow this line, this is the previous low back here, and you can see we didn't really get as low as this one,
Hmm.
but you can see we came down to the 10, which is what I look for. Over
Mm.
on the 50, we'd never made it to the 20, but we got down to like 24.
Mm.
And on the 200, we never made it to the 30, but we got down to like, it was like 37, I think,
Okay.
on that one. But on this time, look how low it went this time.
Yeah.
So this is like a rubber band getting stretched, getting
Yeah.
ready
It's
to
just
snap back. And
mean
the rubber
reversion.
band was stretched so much, you can see how much it snapped back on
Yeah.
just on one day. So that in itself should not have been surprising. Now, there's no way to tell what was going to cause that, what the catalyst
Sure.
for it would be,
Yep.
but we obviously had a catalyst for it. But this is my
Yeah.
bottom finder chart that will identify bottoms.
Yeah.
Now,
One thing we can say, because we've been seeing this together for years, is it is very valuable. We now have more and more evidence it works.
absolutely. Down here, the VIX made it up to 60.
Yeah, I think it was
That's
like 62 or something. Yeah, it was
Yeah, that's the
great.
highest it's been since COVID.
Yep, correct.
And that again is when bottoms occur. And
And
the
it's
put
still
call
high, right? It's still
and
almost
it's
40.
still high, but it's coming down
Yeah, okay.
because we're rallying, and I think we're going to rally a little bit more.
Okay.
The put call ratio, I look for that to get above 72.
Mhm.
This is a 5-day moving average, so the actual put call is actually higher than that because this is an average, right? So it
Yeah.
actually probably made it up into 76, 77. I don't know what the exact number was, but the 5-day moving average made it to 72. Actually, I think it was 73 or 74.
Mm.
That's what I've been waiting for. Whenever we had this drop right here, and then we got a rally, and people said, I think it's over. And I said,
I
no,
don't
it's
think
not
so.
over. I need to see more bearishness.
Mhm.
There are not enough people that are throwing in the towel and buying puts. Everybody's still buying calls. Everyone's buying the dip.
Yeah.
On one of my YouTube videos last week, the topic was buy the frickin' dip or sell the frickin' rip.
Mm.
Which do you do? And I said, my opinion is you sell the rip. You don't
Nice.
buy the dip.
Nice.
And I'm still of that opinion, although we still might get a little bit more of a rally.
Cool.
All right. So the other thing to watch for is I think we're going to have another leg lower.
Mm.
And the thing to keep an eye on, and I'll continue to alert subscribers to this. If we go lower than this, which I think we will, then will these three right
Mm.
here actually go higher?
Interesting.
Will they not go lower? If this goes lower and these don't go that low,
Mm.
then that is a bullish divergence when that
Got it.
happens.
Yeah.
And that's when the bottom is in.
Yep.
But
The
right now, I do
divergence.
not think the bottom is in yet. I think we have more downside to go.
Well, let's talk about that because again, the stock market, my opinion, is nothing more than a forward indicator on earnings, right? What are you paying
Ah,
for some for future earnings? And I think
earnings.
I think we're about to have a disaster of an earnings seasons with many people, many companies pulling guidance, and others that do choose to put guidance are going to take it way down. So
So
it's
that's
going to be
interesting. You should say that because that's the two people that I mentioned before that were trying to justify why the market was going higher.
mm,
Both of them said, well, earnings are actually pretty good. And the
doesn't
one
freaking
guy, the
matter.
one guy said I said earnings just started Friday. How can you say they're pretty good? We haven't even seen them yet.
Yeah,
I said
just
earnings last quarter were pretty good,
yeah.
and I said and earnings this quarter will probably be pretty good.
Yeah, there'll be plenty of
Guidance
beats
will,
this year. It doesn't freaking matter.
guidance will not be pretty good. In fact,
No.
even if companies think their guidance will be okay, they are going to take this opportunity to throw everything in the kitchen sink into the negative column to say why their forward guidance should not be very good. They're going to set
100%. Yes.
they're going to set themselves up to be able to beat earnings next quarter or the quarter after, probably after the one
For
at the
the year. Yes.
very end of the year, right? They're going to set all of that up this quarter. They're going to throw every negative thing they can possibly think of into earnings this time, even if
Let me
earnings
say
are
it very clearly. I was an accountant. I was a part of people producing balance sheets and income statements for publicly traded companies. And let me just tell you how it works in the boardroom. When you are going out there and you're going to have a tough quarter, but for whatever reason, you're the only company having a tough quarter,
right.
that is when you get punished.
Mm-hmm.
However, in the environment we are walking into, you're a moron if you report a rosy picture.
Right.
You're moronic. You should
That's
take
right.
this opportunity to tell
Even
everything.
if you believe there is a rosy picture.
Yeah, don't do it. You are foolish to do it. So they will not. It'll be an ugly guidance period.
Right. That's right. And that's what will push them lower. Now, we just started, and JP Morgan actually had pretty good earnings,
Yep.
and their stock did pretty well.
Did okay.
Um,
Yeah.
Wells Fargo had decent earnings but bad guidance, and their stock
Yep.
got punished.
Yep.
And so next week we're going to see more banks reporting.
Yeah, we get a
Um,
good Goldman and somebody else early, like Bank of America. Then the regional banks, that's the one I'm looking for. Regional banks,
right,
which start Wednesday.
right.
Whew.
So this chart right here, I've shown this before many times. I showed it way back over here when I was telling everybody we were in a distribution phase. I initially I had a question mark on this distribution phase question mark.
Yep.
I should actually put an exclamation point now.
Yeah, you nailed it.
But I said that this image down here are the market cycles. This is from Charles Dow going back to 1900, 125 years ago. This
Yep.
was his Dow. This is Dow theory, part of Dow theory. This is how markets act: accumulation phase, a markup phase, distribution phase, and then a markdown phase. We've had this. When we were up here, I said we are in a distribution phase. I don't know when it's going to break, but when it does, we will start this process right here.
Yep. Yep.
So it broke through. We went down. We came back up right here. I thought we might come a little higher, but we didn't. We came back up right there. Then we had a huge sell off right there. And now we're on our way back up, which is right here in this little area. So we're heading back up, and you can see the trend line that I drew in here now across the tops, the highs. That's a lower high. Now we have a lower low as well. So we have two lower lows, and we have two lower.
Do you think 4,500 or heaven forbid 4,200 are possible?
Well, anything's possible.
Okay.
But I think probably 40, we made it to 49. So I think 45 is possible.
Yeah, because you have
Um,
a Fibonacci down there at 4,200.
yeah, well, that's where it started. Actually, this one here is the blue one. So this is actually 161% Fibonacci. So yes, that is an extension. So the blue one is started. It's up here down to this low right here.
Got it. Okay. And then you're
So
just going
so think of it this way: the top, when we hit the top, that's zero.
right.
This one right here is 100%.
Got it.
So that's where I drew the lines from. So
Yep.
this Fibonacci is 161%.
Got it. Okay.
So yes, 4,200 is where we could go to.
Okay.
We'll see if we get that low, but I do think we're going to put in a new low. I do think we will go lower than this low. So this low right here was 21.4% down.
Got it.
Oops. Go back to that. Keep forgetting I can't click on a slide.
Hmm.
Right now we're at minus 12.8. I think we're going to get more of a rally. I think we're probably going to go up to this downtrend line and maybe to this next Fibonacci, which is 5,500. So I think somewhere around 5,500 to 5,550, somewhere between 5,500 and 5,600. None of these you can never have exact numbers on any of these things.
Course.
The market doesn't know where I draw the lines. It has no
Right.
idea. But somewhere
Okay.
somewhere in that neighborhood. But every other trader using technical analysis knows where the lines are drawn. So somewhere
No,
in this.
it's really funny you bring this up because I'm seeing more people on CNBC and Bloomberg and other Fox News and all these other places using uh, this, and their lines are basically where yours are. So the point that you've said now for 5 years that all the trading houses have guys that do this, is absolutely smack dab. They're all looking at the same stuff.
Yeah, and guys that are way better at it than I am. So
Yeah.
so yeah, so that's I think we're going to get the rally up into this area, and then we're going to sell off again.
Yeah.
Probably go to a lower low. We'll see if it's a V like this again, go down
Okay.
and come right back up. I don't know. If we follow, this Charles Dow theory, then we're going to bounce around
Hmm.
down here for a little while. We'll see, but I do not think that this is the end. I think we're going lower. I think you're going to have a chance to get out in the next week or so as we
Yeah.
as we rally a little bit higher. Again, it's better to take a small loss than to take a big loss.
Hmm.
So keep that in mind.
Yeah.
All right, let me go to my newsletter real quick.
Okay. Yeah. Got a couple more things to hit.
Yeah. So for anybody, if you come to breakpointtrading.net, this little box right here has my newsletter that I put out every week because I was so busy yesterday. I didn't get it out till today,
Hmm.
but it just went
It's
out.
okay. It happens.
I always have cartoons. There's also the YouTube channel link is in here too. This is what happened last week. Bouncing market,
Yeah.
bull riding.
There you
Now here's our own Ted Slimbuck to explain all those recent ups and downs in the stock market.
go. That's
All right, let me I put some links. Here's PPI, by the way.
yeah.
That's what PPI looks like. I put some this was interesting. I had one of my subscribers sent me this, and he said, "Hey, look at this. We shouldn't really be worried because this is the
Yeah.
third best rally since World War II." And I
Yeah.
said, take a look at the years on those other rallies.
Exactly.
What do you
Not,
notice? What do you
not
notice is
necessarily a
similar?
good thing.
Right. So I sent him back this one. Biggest up days are in bear markets.
Exactly.
So, and they're surrounded by the biggest down days.
Yep.
So don't get too excited. I just showed that. Just showed that one. Now I've added gold to that one. Okay, so here's one, and the link to the articles are right in here. Fed can't say this one why bonds may break the stock market in 25. This is basically what we were just talking about.
This
But
is a big deal, folks. I would definitely click that
it's a
link.
big deal. But this goes into a lot more detail on why it's happening. So it's a really, really interesting article. And this one is too. Why is China selling US treasuries and what it means?
Yep.
So this goes into explanation of why China is selling, and China up till now has been doing it for some solid financial reasons.
Sure.
They're overweighted the U.S. market, so it
Yep.
makes sense to pull back. But suppose China is in a trade war. Every time we raise tariffs, they raise tariffs. They're not
Hmm.
coming to the table to negotiate. They're just raising reciprocal tariffs. But what if they decide one of the weapons in their arsenal is U.S. bonds?
Yeah,
Or
could happen.
what if they decide they're not going to continue buying U.S. bonds? Or even worse, what if they decide they're going to start selling their U.S. bonds? Even if it will hurt them, because it will hurt them as
Well,
well.
yeah, it'll hurt both sides. Yeah.
The dollar is the reserve currency, so they need dollars to do business around the world. So it
Yep.
will hurt them as well. But what it will do, especially right now, this whole topic that we've been discussing, with 25% of our debt coming due this year,
It'll hurt
it'll
huge.
yes, it'll be huge if they decide to sell treasuries, even on a temporary basis, to drive our 10-year yield much higher
Yeah.
when we refinance. By the way,
Yeah.
another thing that I read,
It's a really simple thing. If you add more supply to something, what happens? It goes
right,
down in value. And but
right,
bonds have this reverse thing that says rates go up.
right.
So
That's right.
not good for the US. And
There's another,
frankly, not very bad for the US.
there was something else, I think it was in this article, that said that we are about 124% of debt to GDP right now.
Yes, we are. Correct.
The interesting comment, and I haven't researched it, but the comment in the article was historically, when any country gets to 130%, they default on their bonds. And that is without exception.
Oh, that's that. Well, that's blatantly false. Japan is at roughly 200%, uh, uh,
Okay, so
and that's blatantly false.
all right, so it
Now,
was an interesting.
well, there's a difference because in Japan, U.S. citizens and Japanese companies buy the bonds, which is a very different behavior than the U.S. But it
Right.
is now that article may have said 130% will default because you're a reserve currency. That could be true
Oh, okay.
uh,
Yeah.
because Great Britain and whatnot when they were the reserve. But it is blatantly false because Japan is a living, breathing example of a country that has 200% debt to
Okay.
GDP,
Yeah.
and
Good
they
point.
haven't defaulted.
Point. So this is real investment advice, which I love these guys. It's a free newsletter, so anybody can sign up for it. I
Hmm.
put the link to it right in here. It has a lot of information this week in this newsletter. They talk about the basis trade,
Oh yeah,
um,
that's something to watch. Yep. Yeah,
especially, it's basically
A Japan fund got caught, they're saying.
well, not only Japan fund, but long-term capital. This is what happened to long-term capital.
Oh yeah, if you don't know how to long-term capital, that's definitely an interesting read.
Right. So that's why, watching credit spreads are so important. And this
Correct.
this chart that I included, there's a lot of other ones, a lot of other information in this newsletter, but this is where the hedge funds are right now. The amount that they have in this basis trade,
Mm.
and they
I
according
did not realize it was that big.
according to this article, the basis trade is primarily responsible for the spike in the 10-year yield last week.
Yeah, no, I think this is underlying. I do agree that the basis trade. And if you guys don't know what this is similar to the yen carry trade that blew up 6 to 8 weeks ago. It's just with U.S. Treasuries.
Right, that's right. They explain in this is the article here. They actually explain what the basis trade is all about. If I could find it real quick. Here's the base. So they explain what it is. Um, it's used by hedge funds to profit from small price discrepancies between treasury bonds and treasury futures. And here's how it works. Hedge funds buy bonds while simultaneously shorting futures or vice versa, betting that the price gap or basis between the two will converge, come back together.
Mhm.
This trade relies heavily on leverage, often 20 to 56 times the initial investment,
It's
borrowed
funny.
through the
I actually heard people sometimes go to 100 times.
yeah. So, while the Fed suggests the hedge fund basis trades leverage is above 50 times, um, and then they explain what this means. So there's that chart right there. Um, they had a really good explanation
Yeah.
down here about, if you don't understand what this means, then that means, 50 times whatever you put in,
Mhm. Yeah.
that's how much you could lose.
Yeah, it's not good. It goes the wrong direction. Leverage works great when you're right, but it'll kill you when you're wrong.
Right. So it could create a liquidation event
Yep.
reminiscent of the repo crisis in 2019 dash for cash during COVID-19.
Yep.
So this this is serious stuff.
Yeah. Folks, as we kind of wrap this up,
If you don't
again, this is
understand that math, it simply means that a 5% loss at 20 times leverage is a 100% loss on the trade.
exactly.
All right. So imagine what it is at 50 times leverage.
Yep. 2% loss is 100.
So this is all very concerning. I am happy to be in cash right now.
There you go.
Um, don't want to scare people, but it's important to understand all this stuff.
Yeah, folks, at the end of the day, as we started this show, the US dollar is acting like a third world currency. It is not supposed to. It could change tomorrow, there's no doubt. But there are lots and lots and lots of concerning factors, lots of things breaking trends. Foreign actors are acting different, as we've seen with the price of gold. So, folks, be careful. Dan, where can people find you and get your daily updates at 7 o'clock?
Breakpointtrading.net. That's the website. The newsletter is right there. The YouTube channel is right in the upper right-hand corner. If you want to subscribe, you get access to all of this information that I have in here, including the Zoom call that I just did one yesterday.
Nice.
It was a short one. It was only 2 hours. The other ones are, you can see 3 hours, 2.5. I put all the recordings out here for subscribers.
Yeah,
and all the newsletters are out here too for subscribers. So
very cool. Well,
that's where you can find me.
Dan, you're amazing. Thanks for you do. It's going to be a busy week for you.
Yes,
Can't
it'll
leave
be
folks
very interesting.
secluded.
Watch for the rally. Let's see how long it lasts. I expect that we might go up. Maybe that news about exempting cell phones,
Chips, yeah, chips and phones and
chips and
computers.
phones. Maybe that's going to give us a rally next week. So we'll
Yep,
see.
maybe.
But I don't think it's going to last. So be careful.
Be careful, folks. Take care. Talk next week.
All right, take care.